Today, we're diving deep into what a stock split really is, why companies do it, and what it could mean for you as an investor. By the end, you'll understand how this seemingly simple financial move can shift accessibility, influence market behavior, and offer opportunities if approached with clarity. And if you want a practical guide to follow along, check the PDF linked in the description. You can start applying these insights today. Slide 1 sets the stage. A stock split may sound technical, but it's essentially a mathematical reshuffling. Imagine you have a pizza cut into 8 slices. Suddenly, the pizza is recut into 16 slices. You still own the same amount of pizza, but the pieces are smaller and more people can share it. That's the essence of a stock split. Your ownership percentage doesn't change, but the price per share drops, making it more accessible. Slide 2 brings us to the roadmap of this journey. We'll explore the types of stock splits, why companies choose to implement them, the benefits and risks, real-world examples, and finally, actionable strategies you can use when encountering them in the market. Keep that roadmap in mind as we uncover each layer. Curiosity will be your compass. Slide 3 asks the core question, if nothing fundamentally changes, why does the market react? The answer lies at the intersection of math psychology and access. A stock split is neutral in value. Your $10,000 investment doesn't magically become $20,000 after a 2-for-1 split, but psychologically it can feel more approachable, inviting new investors, increasing liquidity, and sometimes even sparking a short-term price bump. Slide 4 brings us to the Insight Architect stage. Lesson 1, what a stock split is. Picture it this way. You own 100 shares at $100 each. A 2-for-1 split occurs. Now you have 200 shares at $50 each. Same total value, same stake in the company, just more shares at a lower price. It's easy to see why this can attract retail investors. Suddenly, what seemed expensive feels reachable. Building on that idea, Slide 5 explores the 2 main types, forward and reverse splits. Forward splits increase the number of shares, lowering the price. Think of it as a company saying, we're growing and we want more people to join. Reverse splits, on the other hand, consolidate shares, raising the price. Companies do this often to meet exchange requirements or to appear more appealing to institutional investors. Notice how the same mechanism can signal entirely different narratives depending on the intention. Slide 6 dives deeper into forward splits. Companies pursue them for a few key reasons: to make shares affordable, boost liquidity, and signal confidence. Tesla's 2020 split is a perfect example. After the announcement, millions of retail investors jumped in. The price per share dropped, and suddenly, what was once intimidatingly expensive became manageable for smaller investors. Here, behavioral psychology is quietly at work. Lower numbers feel easier, even if the underlying value hasn't changed. Shifting focus, Slide 7 examines reverse splits. These are often defensive. A company might do a reverse split to maintain listing standards or distance itself from the penny stock label. Citigroup's 2011 reverse split is illustrative. It helped stabilize the listing after the crisis, but it also reminded investors that the company was navigating recovery. Reverse splits can be necessary, but they often signal caution. Slide 8 brings us to the upside for investors. Forward splits can make investing psychologically easier, increase liquidity, and sometimes spark short-term momentum. Amazon, for instance, has executed multiple splits over the years, inviting waves of new investors each time. It's a subtle reminder: accessibility can create attention, and attention can create opportunity. But here's the caveat: attention alone doesn't guarantee long-term returns. Slide 9 is all about risks. A stock split rearranges numbers, but doesn't repair a struggling business. Reverse splits, in particular, may signal distress. Data shows that 20 to 30% of splits underperform long-term if they aren't backed by solid fundamentals. As an investor, it's critical to look beyond the headline. A lower price or increased volume might feel exciting, but fundamentals are the anchor that will keep you steady in volatile waters. Next, Slide 10 highlights real-world examples. NVIDIA's 10-for-1 split in 2024 made shares accessible amid the AI boom, while Walmart's 3-for-1 split increased retail appeal without changing underlying value. Citigroup's reverse split shows the cautionary side. Studying these cases helps you understand timing, context, and the subtle cues that differentiate opportunity from mere spectacle. Slide 11 transitions us into actionable takeaways, the engagement enchanter stage. First, always check fundamentals before reacting to a split announcement. Second, use splits as entry points rather than timing signals. Third, track post-split liquidity. Sustained high volume often signals genuine market interest. And finally, treat reverse splits cautiously. They can be a red flag, not a green light. Slide 12 invites reflection. Ask yourself, would you trust a business more simply because its price looks cheaper? Where else in life do numbers change, but reality doesn't? By internalizing this lesson, you start to see stock splits not as instant opportunities, but as tools to inform your strategy, to think critically, and to act patiently. Slide 13 closes with the final thought. A stock split isn't a gift, it's an invitation. It opens doors, but the choice to walk through them wisely is yours. The patient investor asks, what stays true after the numbers change? That question alone can shift your perspective, guiding you to focus on value over spectacle, patience over panic, and clarity over hype. Remember, if you want a practical companion to today's video, download the PDF in the description. It breaks down the lessons, reflection prompts, and step-by-step strategies you can apply immediately. And if you enjoyed this exploration, hit subscribe, tap the notification bell, and stay curious. Markets evolve, and so can your approach, one informed step at a time. You now have the tools to see stock splits not as noise, but as a window into accessibility, psychology, and strategy. Next time a split hits the news, you'll know not just what it is, but why it matters, and how you can act intelligently. Start small, observe, reflect, and build confidence. That's how knowledge compounds.